Russia and Ukraine. The Russian invasion of Ukraine on February 24 kicked off historic policy actions and moves across global markets. The Russian ruble continues to reach all-time lows and the Russian equity market has remained closed since February 25, while oil has surged over the $130 per barrel (BBL) mark for the first time since 2008 and gas prices have spiked to all-time highs. The global coordination of sanctions has included the European Union, EU, the US, the UK, Canada, Switzerland, Japan, Australia, and Taiwan. On March 8, U.S. President Biden signed an executive order to ban the import of Russian oil, liquefied natural gas, LNG, and coal to the United States and also banned new U.S. investment into Russia's energy sector. The UK pledged to phase out Russian oil imports by the end of the year while the EU unveiled a new energy security proposal to diversify supply away from Russia, focusing on LNG and pipeline gas supply. The G7 also announced plans to strip Russia of most favored nation status, with the U.S. House of Representatives approving this measure on March 17. Russia's invasion of Ukraine will slow global growth and raise inflation. J.P. Morgan Research views the macroeconomic impact largely through the commodity markets, while the financial linkages between Russia and the rest of the world are comparatively smaller. J.P. Morgan Research projects a high risk of large energy supply disruptions, with Brent oil price to remain elevated between $100 to $185 BBL given the possibility of more severe sanctions. What sanctions have been imposed on Russia and can they change the course of the conflict? Sanctions and export controls have been broad-based to date, targeting Russian banks, exports of high-tech assets, and the issuance of Russian sovereign debt and equity. Some banks were removed from the Society for Worldwide Interbank Financial Telecommunication (SWIFT) financial messaging system, a key piece of banking infrastructure that facilitates payments of all kinds in the economy. Sanctions were also applied to Russia's central bank, which impacts the country's more than $600 billion of foreign currency reserves, as well as Moscow's ability to stabilize volatility in the ruble and protect the economy from the wider disruptions of conflict. This led the Russian central bank to hike its key interest rate from 9.5% to 20% and to the imposition of capital controls. Russia's central bank has also temporarily banned sales of local securities by foreigners and banned payments of dividends and interest on bonds to foreigners. Around 15% of Russia's exports are settled in ruble, around 55% are settled in USD and 30% in other hard currencies. Therefore, restrictions on USD settlement can also seriously disrupt these transactions, even if Russia's trading partners are willing to import. Sanctions were also applied to business leaders, oligarchs, seen as close to Putin. The conflict has revealed extreme tension between European energy security and the region's primary energy supplier, a relationship that goes back more than 60 years, said Joyce Chang, chair of global research. Germany's decision to suspend the certification process for Nord Stream 2 signals a rethink of European energy strategy. The U.S. followed suit and issued sanctions targeting the company that built the pipeline. As of March 20, large quantities of Russian oil are still struggling to find buyers even at discounted prices. On March 15, the EU announced a fourth round of sanctions that included a ban on new investments in the Russia energy sector, including its power sector, and a prohibition on all new transactions with Rosneft, Transneft, and Gazpromneft, but fell short of a full ban on oil and gasoline imports.